Good afternoon, everyone. This is such an incredible event. First, I wanted to thank Mercado Bitcoin for inviting me to speak today, as well as thanking all of you for coming to learn and to discuss Bitcoin and digital assets more broadly. This is still such an early time in this industry, and as I'll talk about a little bit more in our presentation, for many investors in the United States and around the world, we're still just at the starting point for digital assets. We've still just started to make these assets more accessible to more investors and more portfolios around the world. So for many of you here, I know your journey maybe started many years ago for digital assets, but recognizing that the larger world outside, we're still in day one for many investors. At BlackRock, we are the world's largest asset manager in the world, managing $10.5 trillion globally. And our digital asset journey started about 5 years ago, where we really started to think through what role can we play in digital assets for our clients. We were hearing questions from clients about how can I access Bitcoin, how can I access Ethereum, what does it mean to add this asset to our portfolio? And we spent a good amount of time studying these assets and studying the role that we could play in digital assets. We did a multi-year technology integration with our Aladdin trading platform to bring in digital assets to sit alongside stocks and bonds and other assets. We brought out a private trust in 2022 to provide direct access to Bitcoin to institutional investors for the first time. And all of this culminated in the launch of our Bitcoin and Ethereum ETFs this year, which the Bitcoin ETF is now the largest Bitcoin ETF in the world, bringing over $20 billion in about 5 months. So we are in the middle of our journey, but now it's our duty to help people understand better these assets that we're making accessible through our ETFs. As the head of thematic investing at BlackRock, I really spend a lot of my time thinking about the future and some of the disruptive changes that are impacting the world and society and the economy and our portfolios around us. Oftentimes, this is about disruptive technologies. Oftentimes, it's about societal changes. But what we found with blockchain and digital assets is that in some ways, this is one of the fastest growing technologies we've seen in the last few years. On the right-hand side of the chart, you can see our adoption curve. This is just looking at how quickly certain assets are adopted by a society. And you can see that blockchain and digital assets are being adopted faster than major revolutions before it, whether that's the internet or whether that's cell phones. And there's a couple of reasons for this. The first reason is just we're living in a more digital economy than ever before. If we're consuming things online, streaming videos, playing video games, buying digital content, it makes sense to have digitally native assets to conduct those transactions, particularly when there's fewer borders to the transactions and we're conducting these transactions around the world. Secondly, and importantly, in a year like this year, where over half the world's population is voting for new leadership, not just the elections in the United States, in Mexico, in India, and the European Union, we're seeing more geopolitical risk than before, and in fact, declining trust in institutions. Whether that's trust in government institutions for maintaining peace and order, whether that's trust in central banks in terms of keeping inflation under control, more distrust has exacerbated the need for a global monetary alternative. The third we're seeing is demographic changes, the rise of the millennial and Gen Z generation. Millennials, at least in the United States, are set to inherit trillions of dollars, are entering peak earnings years in their work, and are increasingly playing an important role in the economy. And millennials are very different from previous generations because we, were the first generation to be digitally native, growing up with the internet, growing up with computers. We understand digital better than previous generations, and that means we're more likely to adopt digital currencies. And then finally, what I think has been really important to BlackRock in our journey in the digital asset space has been the maturing of the infrastructure in digital assets. We've seen billions of dollars move in venture capital and private equity into digital assets to fund incredible innovation in blockchain. We've seen the regulatory environment evolve to get more constructive around digital assets and how people can buy them. We've seen extremely talented people leave traditional finance to go into DeFi to help lead some of these innovations. And all of this infrastructure has really matured over the last 5 years. So between all of these tailwinds, it's really creating the opportunity for digital assets to gain broader adoption across more investors around the world. With that being said, we're still in the early days. 2.9 trillion, it changes every day. Maybe it's slightly higher or slightly lower since we made this slide. But we could call it around $3 trillion in digital assets value. It's a lot. It's legitimate. This is a serious amount of money and value. But when you compare it to other traditional asset classes, gold is a $15 trillion asset class globally. The stock market globally, 100 to 200 trillion. Fixed income bonds are about $300 or $400 trillion. What we see is that all the progress we've made in digital assets, we're still very early in terms of how broadly these assets have been adopted and the value that they contain relative to traditional assets. But we're seeing growth in terms of transactions being settled on the blockchain. We're seeing growth of stable coins. We're seeing billions of dollars in venture capital find their way to digital assets. This journey is accelerating, but it's still early. Now, for us at BlackRock, we are really focused on bringing out more accessibility to the largest digital assets in the world. We have focused thus far our efforts on two digital assets, the two largest, Bitcoin and Ethereum. We feel that between these two assets, which represent about 75% of the market cap of the digital asset space and have some of the most liquidity in the digital asset space, that we can really start to make headway in terms of bringing out accessible vehicles to more investors. Now, what I'm going to talk about a little bit with all of you over the next several minutes is a little bit about how we talk about these assets with our clients. I recognize this audience is a little more digital asset savvy. All of you have maybe started your journey earlier than others, but I want to kind of pull back the curtain a little bit in terms of how we think about digital assets and the types of conversations we're having with investors in the United States and Brazil and beyond about the role that these assets can play in a portfolio. Now, the first thing that we've recognized in our conversations with clients is often when people are new to digital assets, they just think about it all as one thing. I've got my traditional assets over here, my stocks and bonds, and then these things called digital assets over here. And they haven't really made the distinction between digital assets, that there could be a difference between Bitcoin and that there's differences with Ethereum that don't make them all the same. The way we like to talk about Bitcoin is it is a global monetary alternative. That when we see increasing amounts of geopolitical risk, when we see inflation and monetary risk, when we see that there's more desire for a global monetary alternative, that Bitcoin benefits from that use case, the need for something besides existing fiat currencies or gold or treasuries. Now, with Ethereum, it's a very different use case. We see it as a bet on further blockchain technology, that Ethereum would benefit from the rise of stablecoins or NFTs or tokenization, that more utilization of blockchain technology will generally benefit Ethereum. So on one hand, you have something that looks a little more like a commodity with Bitcoin, a little more like gold, a little bit more of an alternative to stocks and bonds. Ethereum, more of a long-term technology bet, that this blockchain thing is going to provide more use cases and more value to the economy going forward. Now, the other conversation we have with clients is not just about education for the assets themselves, but the reason why professional investors should care about digital assets. It's not just about the returns or how it fits in a portfolio or the diversification. It's also about how can you be a better financial professional to your clients. What we found is that there's hundreds of millions of people that are investing in these digital assets, but they're holding it away from their financial professionals. That these individuals are buying assets, holding it onto it themselves, and they're not allowing financial professionals to help manage it alongside stocks and bonds, to help them understand the tax consequences of these assets, to understand estate planning or charitable giving, all the things that financial professionals can provide. They hadn't had the opportunity to do that for their clients because they didn't even know their clients were investing in these things. Over 80%, 4 out of 5 millennial millionaires in the United States own crypto. So if you're a financial advisor and you're trying to get that next client of the future, you want to be able to offer your services to a millennial, a high-earning millennial, and you don't know how to talk about digital assets or talk about the value that you can provide as a financial professional with respect to crypto, it's going to be very hard to earn that trust and to earn that client. So again, it's not just about the return story or the technology story or the diversification story around digital assets. For financial professionals, it's also about how do you appeal to the next generation of investors and to provide your services to that client. So we spend a lot of our time in these conversations with financial professionals really trying to peel things apart with Bitcoin, with Ethereum, to help them understand on their educational journey what these assets are and what they can do within a portfolio. And often these conversations really start with just basics around what is currency? What is the fiat currency that we use every day, the dollars, the reals around the world? And what are some of the shortcomings that create an opportunity for an asset like Bitcoin to exist? Currencies are a way to facilitate transactions, they're a store of value, and they're a unit of account. But what we found with fiat currencies is that they're not perfect. In fact, they're prone to inflation, which for many Americans we didn't really realize was a thing until a couple of years ago when inflation hit 9%, and suddenly a lot of American investors started wondering, what's the deal with inflation? How do I potentially protect against it? That it's very expensive to move money across borders and takes time, that the average remittance could be 5% to send money back home and take almost a week to occur. Again, for many Americans, maybe not something we spent a lot of time thinking about, but we see more money moving across borders to be able to facilitate remittances. That's a huge pain point. And then finally, the risk of seizure or censorship, that maybe the fiat currency that you own in your wallet or you have in your bank account maybe isn't entirely yours. And under certain authoritarian regimes, it could be confiscated. So, of course, with Bitcoin and digital assets, a lot of them exist to try to solve these challenges with fiat currencies or to provide an alternative to fiat currencies. We know that with Bitcoin having a fixed amount of units at 21 million, that because of its digital nature can cross across borders instantaneously with low cost, and that its decentralized nature really helps solve some of the centralized challenges you could have with authoritarianism or censorship. So we like to see this really as an alternative to fiat currencies. Now, the question we often get when we talk about Bitcoin as an alternative is, well, I could just put my money in US Treasuries, get some yield, I don't have to worry about inflation, it's gonna kind of adjust. Why would this be better than just what I'm doing today? Or why don't I just buy gold? And of course, Bitcoin has some advantages versus these assets. If you look at the US dollar itself, and I was kind of joking, Americans didn't know about inflation until a couple of years ago, but if you zoom out and look at the longer picture, 110 years, you see that the dollar has lost 97% of its value. It hasn't been a great store of value, and yet around the world it is viewed as one of the biggest stores of value. And it's because the supply is unfixed. In strained economies where we want to build more liquidity, like around COVID, we can print a lot more dollars and start bringing inflation into the economy. So Bitcoin, with its fixed nature, can help solve that. With its decentralized governance, can help solve that. In fact, has many advantages over gold as well because of its totally fixed supply and because it can be a more efficient medium of exchange. Now, in many ways, these challenges don't seem to be going away. If you look at the political discourse in the United States today, there's very little mention of the growing debt load. We've seen debts expand in the United States. This is not just something in the United States alone. We see this around the world. This is being propelled by aging populations where we have to spend more money to support more of society, crumbling infrastructure where we have to rebuild physical and digital infrastructure and energy infrastructure around the world. So debt growth in the United States and around the world doesn't seem to be stopping. So if you believe in this need for a currency that can be a bit of a hedge against the risk of inflation, then that's not going to be going away anytime soon, even if interest rates start to come down a little bit in the United States. And of course, everything I've been saying thus far has been a very US-centric view of the world. If you take a step back and look at other countries over the last 20, 25 years, you see that this is not an American phenomenon. This is a global phenomenon, if not even more critical overseas, where you see even more inflation. So what does it mean if you add Bitcoin to a portfolio? Well, of course, I think one of the things we have to recognize is that this is a risky asset. If we look over the course of Bitcoin's history, In some years, it has been the best performing asset versus other traditional assets like stocks and bonds and gold and commodities. But every 3 or 4 years, you see that it's also been the worst performing asset. You can have very high highs and very low lows in Bitcoin. And this is important for people to understand because I think a lot of investors, as they look to Bitcoin, only focus on one or the other. They either see the phenomenal returns or they see the headlines of the major sell-offs, and they don't realize that there's a bigger picture here of how Bitcoin has performed over certain environments. Another way of looking at this is through the cumulative return of Bitcoin. We can see that it's obviously grown significantly over the last 15 years, but there's been periods of major drawdowns. Drawdowns more than 50% have occurred 4 times. Bitcoin has recovered from those drawdowns, but for investors that are looking for stability or can't handle drawdowns, Bitcoin might not be the best asset for their portfolios. As we've seen more adoption of Bitcoin and we've seen the price increase over the last several years, this risky asset has continued to maintain its volatility, and you can see this on the left-hand chart, but volatility has started to come down. Its standard deviation is about 50 right now, which is significantly less than it was 5 years ago, but is still about 2.5 times higher than the S&P 500 or US stocks. So again, for investors in this nascent asset, they have to understand the risks, the ups and the downs, the drawdowns of Bitcoin, the volatility and the trend. We would expect if we see more adoption of Bitcoin, which we believe will happen, that volatility will continue to fall, but it'll continue to be a risky asset relative to things like stocks and bonds. And importantly, a big part of the use case for Bitcoin is not just about the return story or the volatility story, it's about the correlation story. That Bitcoin fundamentally behaves very differently from traditional asset classes. Whether you compare it to stocks, whether you compare it to gold, it looks very different because fundamentally the drivers of Bitcoin are very different than the drivers of stocks. I'll skip ahead a couple slides, but we recently published a paper really trying to decode Bitcoin from a risk perspective. What we found was that if you read the newspaper and there's some articles about Bitcoin, people were trying to tie the Bitcoin story to the same stories that they tie stocks to. That if we were in a risk-off environment and stocks were selling off, Bitcoin would be selling off, and it was just seen as this kind of risk-on asset. But we found this to be a really kind of unhelpful narrative for Bitcoin as an asset because the drivers over the long term that make stocks a growth story are very different from the drivers that make Bitcoin a growth story. Stocks like certainty, they like lower volatility, they like low inflation, they like stable political environments. That's all risk on in traditional finance. When you have this kind of Goldilocks period, that's great for stocks, you see great returns. Fundamentally, what drives Bitcoin, as we've been saying, is geopolitical uncertainty, higher risk of inflation, more need for cross-border transactions. It's actually almost in many ways the opposite of what is the driver of the Goldilocks period for stocks. So we felt that this risk-on, risk-off narrative of thinking about Bitcoin that you see in the newspaper is really not helpful and also not really accurate as a way of describing the role that Bitcoin can play in a portfolio. That it truly is a unique asset, and you can't look at what it's doing on a one-day basis in response to a COVID outbreak or to an election or to a regional banking crisis. If you take a step back and look over the course of several months, you'll see that it is very much a different diversifying asset in a portfolio. So we've done a little bit of work in terms of what does this mean from a portfolio perspective? What happens if you add Bitcoin to a portfolio? And I'll start by showing you just kind of a global portfolio, your classic 60-40, 60% ACWI, 40% bonds portfolio, with just little slivers to Bitcoin. 1% allocated to Bitcoin coming from the equity part of your portfolio, or 3% of Bitcoin coming from the equity part of your portfolio. And we found a couple of things. One is, looking backwards, Bitcoin has performed very well over the long term. It increased the returns of portfolios. We also found Bitcoin is a risky asset. It increased the volatility of portfolios. But interestingly, the return of portfolios increased more than the risk. And what this is really highlighting is the diversification property of Bitcoin, that because it is not very correlated to stocks and bonds, you get a little bit of benefit from it being a different type of asset in your portfolio. It's not contributing as much volatility as it is returns. But as you start to add more Bitcoin to a portfolio, once you get over 5%, as you're getting into double digits, what you see is that diversification benefit starts to fall off. Because when you start adding more and more quantity to your portfolio, it's no longer serving as a diversifier. It is your portfolio. So what we have found is that in kind of small increments for traditional portfolios, you get kind of the best bang for your buck, if you will, in terms of adding returns potential while diversifying some of that risk. And it really didn't matter what time period you looked at. If you looked at 1 year, 3 year, 5 years, you could see that this was the story. It didn't so much matter, oh, I bought Bitcoin during a bull run or I bought it during digital assets winter. It was a very consistent story. That returns contribution and the volatility contribution held up over different time periods. So we've run this analysis for Brazil as well. We understand that in Brazil, the 60-40 portfolio looks a little bit more like a 70-30 portfolio with investors primarily investing in bonds with a bit of Bovespa exposure. So what we did here was a very similar exercise of taking a little bit of that Brazilian stock exposure and allocating it to Bitcoin, 1%, 3%, or 5%. In fact, what we found for Brazilian investors is there's actually even more of a diversification effect for Bitcoin versus the local stock market. Because in this case, Bitcoin, you have a bit more of an FX decorrelation as it's being priced in US dollars. So a small sliver of Bitcoin contributed to the return, actually in a 1% exposure. It reduced the volatility of a portfolio. That's how much of a diversifier it was in small increments. As you add 3%, as you add 5%, as I was mentioning before, the more you add to a portfolio, the less benefit you get from that diversification, and you start to see volatility increase. Again, doesn't matter what time period you looked at, we saw very consistent messaging across kind of all ways that you could include Bitcoin in a portfolio, no matter the time frame. Now, the important thing for investors, once we get through what is Bitcoin, why is there a need for a monetary alternative, how does it fit into a portfolio, is to really reiterate the long-term use case of this asset. That if you're looking at Bitcoin, we don't believe this is a tactical trade for most investors. This is really about a long-term allocation. And another way to help people kind of conceptualize this is as you start to own Bitcoin for longer time periods, really any period over 3 years, we found that your returns were positive. In the near term, you can have a ton of volatility. We've seen major sell-offs in Bitcoin. We've seen major sell-offs in Bitcoin over the course of weeks and months. But if you're able to hold on to the long term, at least 3 years, 4 years, 5 years, your odds of having a positive contribution to your portfolio historically had increased significantly. So I'll wrap up my presentation here and open it up to some more questions. But again, as we really kind of walk through this new technology, this new asset for many investors, one, this is the start of a journey for many investors. In the United States, a lot of financial professionals did not have a way to invest in Bitcoin or Ethereum until ETFs came out. Either they couldn't get exposure, or the exposure they could get was through not great solutions, derivatives or tracking stocks that really had low correlation to Bitcoin and Ethereum. So since the ETFs launched, suddenly a very wide pool of investors that have access to US capital markets can now consider Bitcoin and Ethereum in their portfolios. But the consideration is just the beginning. This is just the start for so many investors as they look at a new asset for the very first time. We found that education has been incredibly important for these investors, whether they are institutions, whether they are wealth managers, whether they are end investors. There is a broad need for people to understand how these assets work more clearly. The second is the need for understanding what it means in a portfolio. Too often, people have been holding these assets far away from their traditional assets, and they didn't understand how these things work together. What is the diversification of benefit of Bitcoin or Ethereum relative to traditional stocks and bonds? And the third thing that we found was that they didn't really understand the direction of travel for their business. that if you are a financial advisor, if you're an institution, that your client of the future is going to be asking you questions about these digital assets. You need to be ready for those questions, and you need to be ready to help your clients when you have those questions of what can you do as a financial professional to help them better incorporate these assets into their portfolio. So I'll pause there, and I know we have some questions that people can be submitting into their phones, and I'm happy to open it up.
Jay, thank you so much for sharing such relevant, inspiring content with us. So now let's move on to the questions from audience that were submitted during the presentation. Feel free to send additional questions using the QR code on the screen. And we will address them as time allows us in line with our schedule, okay? So first question that I got here, it's what role do digital assets play in a diversified investment strategy?
So this is one of the areas where we've seen some of the most adoption of digital assets is really viewing it as a liquid alternative. We hear so much from clients that they want a different type of asset in their portfolio. They want something different from stocks and bonds. If you look over the last couple of years, there's been this rising correlation between stocks and bonds. It's been very difficult to get diversification, particularly in a higher rate environment. And so people have been really kind of trying to scour for the opportunity to get alternatives. Maybe that's going into the private markets like private credit, venture capital, private equity, infrastructure. We've certainly seen tremendous growth of the private markets, but also a lot of investors want liquid alternatives where they have the liquidity to be able to buy and sell these positions essentially instantaneously. So where we've seen some of the most adoption, particularly with our most sophisticated investors, is putting it in the alternatives portion of their portfolio as a liquid alt, really serving as the diversifier. If you look at it through that lens, it takes a little bit of pressure off of the story of, is Bitcoin going to the moon or not? And we can't answer that. But what we can say is that it does behave very differently from stocks and bonds. And that unto itself is a benefit to portfolios.
Great. So another question here. How do you envision crypto assets fitting into a Brazil-specific investment strategy?
Into a very specific investment strategy?
Yeah.
Well, it really, it's hard to paint a picture for every portfolio. What we found is that really it's most important to look at certain types of investors who can take the volatility, that can take the drawdowns, that have a long-term view. And really, when we've worked with a lot of our partners, particularly in the United States, that's where we've seen them allocating. That it's not a one-size-fits-all for Bitcoin. It's really about customizing it for your client to make sure it's the right client for this type of asset. When we've looked at it through that lens, we've seen more aggressive portfolios or moderately aggressive portfolios allocating to Bitcoin in some of the percentages that I was showing before, the 1%, the 2%, the 3% allocations for those more aggressive portfolios.
Great. Another one here. What risks should you take into account when considering adding Bitcoin or other digital assets to an investment plan?
Well, I think there's a few things to take into account. I think first and foremost, this is a nascent asset. So maybe what we've measured over the last 10, 15 years could look different over the next 10 or 15 years. It does not have the history of gold that we can go back on. I think we have to take into account that blockchain technology continues to evolve. I think this is more important for Ethereum, where the technology is regularly being upgraded and evolving to be more relevant as the world evolves and as we try to find new use cases. I think it's important for people to consider that things like correlation and volatility are evolving too. That we could see bouts of more volatility, we could see correlations rise, but what we can measure is really the body of evidence we have over the last 10 years. Again, this is a nascent asset, it's volatile, we can learn a lot from seeing how it behaves in different portfolios. I think in many ways the nascency of this asset is both the risk and the opportunity as more of the world learns about these technologies and these assets.
Okay. I got questions from Henrique Marinho, CEO from Parabellum. Thanks for the nice presentation. It's a pleasure to have you here in Brazil. And Henrique asks, what's a BlackRock long view for Bitcoin? Do you see potential for 15 trillion?
We haven't put out a price target for Bitcoin. We believe as an asset manager, first and foremost, our goal is to provide access to it. And as I've mentioned a few times in the presentation, really a challenge for a lot of investors, particularly on the professional side in the United States, was lack of access, lack of liquid, transparent, high-quality access to Bitcoin and Ethereum. So that's the starting point. Can we put this in an ETF and make it available to more people to make their decisions? If they want Bitcoin, if they don't want Bitcoin, if they do want it, how much, how can you get the best possible structure to get exposure to it? So that's where it starts. The next stage has really been about education, having people understand, helping them understand what the role this asset can play in a portfolio. But ultimately, we leave it to the investor. I'm sure if we polled people in this audience, we'd get several hundred different responses in terms of what the price target of Bitcoin might look like. And some people might be right, some people might be wrong. But we're not here to try to put a price target on Bitcoin. We want to make it accessible, and we want to help people understand Bitcoin first and foremost.
Right. And what were the findings when Ethereum was added to the portfolios?
So we found it was similar, and I know I skipped over a couple slides on Ethereum allocation. In a lot of ways, we found it was similar to Bitcoin. You have a volatile asset that has relatively low correlation to traditional assets, and over the last 10 years or so has had very strong performance. We found the benefit has been a little bit stronger in Bitcoin in recent years, that there's a little more of a diversification impact, especially if you're funding it from equities, because often if you're selling global equities, you're reducing your technology exposure and adding Bitcoin, a very different type of asset. Whereas with Ethereum, you're reducing your equities, which has a lot of technology exposure, and replacing it with something that looks a little bit more like a technology story. As I was talking about, Bitcoin is really more kind of the commodity global monetary alternative. Ethereum is more of this bet on blockchain adoption. So you get a little more of a diversification benefit from Bitcoin, and the returns have been a little bit better with Bitcoin over the longer term. But you get similar types of results when you look at Ethereum.
Okay. And given the historical trend of positive returns after 3 years of holding Bitcoin, what key macroeconomic factors or events could potentially disrupt this pattern for long-term holders in the future?
What could disrupt the path for Bitcoin? Look, in a lot of ways, if we re-enter a Goldilocks period around the world, maybe there's less relevancy for a global monetary alternative. We know this long-term use case is really about growing mistrust of banks, of central banks, of governments. If we enter into a Goldilocks period, maybe there's less demand for it. Just like right now, we're seeing rising prices of gold, and gold is certainly benefiting from some of these same drivers as well. If we enter into a period of more moderating politics, persistent low inflation, less risk of geopolitical strife, then maybe Bitcoin won't have the same relevancy as broadly. I don't think we really see that happening. I spend my time really looking at different themes around the world, and at BlackRock, we released our Mega Forces framework last year, which is really trying to identify what are the 5 major trends that are changing the world today. One of them is geopolitical fragmentation, that we're seeing rising geopolitical risk, changing supply chains. We see this as a very durable theme around the world today. We also see the rise of AI, for more growth of technology, more adoption of technology and digitalization. We see demographic shifts around the world. We see aging populations in some countries, but very youthful populations in emerging markets. I think that can be another tailwind for digital assets, because the markets where digital assets might be most relevant, you also have the most millennials and Gen Zs that are going to be the most digitally native. And we're also just seeing a lot of change in the financial sector. One of our major mega forces is the future of finance and how finance is changing, how people do settlement, how people trade, the types of assets people trade, the role of asset managers versus the role of banks is changing very quickly. And again, Bitcoin and Ethereum and other digital assets are very much at the center of it. So when we take a thematic view of Bitcoin and Ethereum, we can see that there's really powerful long-term forces that are likely to just continue the adoption of this asset going forward.
Okay. And how did BlackRock build its analysis of Bitcoin over time until it finally embraced it. Was there a specific event that was decisive?
I don't think it was a specific event. Like I've said, for all investors, it's a journey. It takes time to learn about these assets. It takes time to get comfortable with them, to understand the role in a portfolio, to understand the technology. And this was a multi-year process at BlackRock. As the largest asset manager, we're going to take our time in something new to really understand it and to understand the role that BlackRock can play in that type of asset. But what we found was a lot of the things that I've been sharing on this slide deck. We found that clients were asking for this exposure, that there were challenges with people trying to get liquid, transparent, high-quality exposure to digital assets. We found that the infrastructure was maturing, that there was a ton of investment going into blockchain technology, going into the entire ecosystem around digital assets, that there were very smart people moving into this space, and that technology was getting better. And then really we underwent this multi-year process to understand these changes, to integrate some of these technologies into our own technology platforms, to play around with it from a portfolio perspective, to understand what value this could provide to a portfolio. And over the course of those 5 years, really the attitude towards these assets turned more positive within the firm. And so I think it wasn't like a light bulb moment necessarily. It was really about this journey. And I think so many financial professionals now are on this journey as well. And it could take time. It could take 5 years for other people to come on board. It might be shorter for others, but we understood the utility that we could play in this space, and I think more financial professionals are going to understand it going forward.
Okay, you got a trick question here. As more and more investment firms come to Bitcoin, what it behave more and more like a traditional asset class and lose this diversification advantage?
No, I don't think so, because at the end of the day, it is about the fundamental drivers of this asset. We shouldn't get too caught up in the day-to-day. We can look a little bit at the week-to-week, we can look at the month-to-month, and we should definitely look at the year-to-year. Over the long term, what drives the value of this asset? We're not trying to tactically trade it. We're trying to understand kind of what are the long-term adoption patterns. As you see more adoption, in a lot of ways, it becomes self-fulfilling, that if more people are using Bitcoin as a potential store of value, as a potential geopolitical and monetary hedge, then we would expect to see volatility continue to come down, but it would still behave like that hedge. Now, I think a really good kind of comparison is to look at gold. Gold's been around forever, and many people have been using it in their portfolios for a long time. Correlation with gold and stocks is still fundamentally pretty low, and it's because, again, the drivers of what makes stocks go up is very different from the drivers of what makes gold go up.
Do you expect institutional markets adopt older cryptocurrencies or staying with BTC and Ethereum?
Everyone's going to be different. You can't generalize for every institution. What we have seen is that it's still very early days for institutions. There's some that maybe had been using futures or had built infrastructure to buy Bitcoin and Ethereum themselves. We've seen some very large institutions in the United States starting to allocate to Bitcoin ETFs. We've seen some pension plans. We've seen some hedge funds. We've seen some multi-asset managers start to make allocations. But again, it's still early days. So I don't think the institutions are ready to go from not investing in digital assets to investing in the 100th largest digital asset. Right now, they're really just starting to get into this space, and it starts with Bitcoin and it starts with Ethereum as you're entering into digital assets because of the size, because of the liquidity, because of the longer track record. These established digital assets just make the most sense for institutions to really consider as their first entry into the space.
Okay, and our last question here. It's from Bruno Cipolla from Franklin Templeton. Thank you, Jay, for your presentation. What's your vision about institutional investor adding digital assets on their portfolio? Are you seeing this change?
We are. And as I was just mentioning, it's early, it's a long journey, but we're starting to see institutions really adding it to their portfolios. Again, the main use case from an institutional investor is a diversifier, that kind of liquid alt story that what fundamentally drives Bitcoin is very different from the other assets in their portfolio. It could look different for other types of investors, but in the institutional space, that's where we're starting to see the early signs of adoption. We've had a ton of conversations with pension funds, with sovereign wealth funds, with banks, asset managers around the world. I would say many more of them are starting to just get curious about this asset. So maybe they didn't think about it very much 5 years ago. Now they at least want to learn. And I think that is just such a great first step in this journey. Maybe they allocate in a few years, maybe they don't, but the fact that they're open to these conversations about learning about the digital assets, learning about the ways they can get access to them, learning about what it means to add it to a portfolio is a good sign. If we look at the wealth space in the United States, right now it's still tremendously early as well. So only about 1 in 200 portfolios have exposure to Bitcoin right now in the wealth management space. Now compare that to the stat that I showed earlier, which was that 4 out of 5 millennial millionaires have crypto exposure. So you have a very big difference between what the young, wealthy Americans are doing versus what financial advisors are doing today. We think there's going to be a bit more of a convergence there, that as more advisors understand the space, that get more accessibility to Bitcoin. One of the features in the US system is not every ETF is available to every investor on every platform. They have to get approved. There has to be people that basically say, yes, we can allow you to buy this. And for Bitcoin, it's still early days there. I mean, we basically can treat those approvers as kind of like institutional due diligence. They're taking their time with this asset like many institutions are. But we've started to see the first platform approvals this year. We've seen a major wirehouse bank, and we've seen a major independent wealth management platform approve Bitcoin. And this is a great first step to making it more accessible to the wealth market as well. So it's not just about pension plans and institutions. It's also about the $30 trillion in wealth management in the United States, which is really just starting their journey as well in this asset.
Okay, thank you very much. It was a great Q&A session. And gostaria de pedir uma salva de palmas a Jade Jacobs.
Thank you.
Thank you.
Thanks so much.